Japan's economic landscape is undergoing its most significant transformation in decades. In this video, we delve into the recent policy shifts and economic developments from 2022 to 2024, including the end of native interest rates, and what this means for Japan's future. How will these changes affect the global economy? And what can other nations learn from Japan's bold moves? Make sure to stick around as we uncover the implications of these pivotal shifts in Japan's economic strategy. Recently, Japan has been reducing its holdings of U.S. Treasuries, indicating a significant shift in its investment strategy. By April 2024, Japan's U.S. Treasury holdings had dropped to their lowest points since January 2020, declining by 18.5% year-over-year to $1.82 trillion. This change is driven by higher yields on Japanese government bonds, which make domestic investments more appealing and raise hedging costs for foreign investors following the Federal Reserve's rate hikes. The Bank of Japan's relaxation of yield curve control has also encouraged the repatriation of capital. As the Federal Reserve's rate hikes increase hedging expenses for foreign investors, U.S. Treasuries become less attractive. Concerns about the U.S. economic outlook and debt levels may prompt Japanese investors to seek safer or more profitable options. Additionally, the Federal Reserve's actions to manage inflation by reducing its debt holdings impact global investment strategies. Japan's decision to decrease its U.S. Treasury holdings could significantly affect the U.S. economy in several ways. Selling a substantial amount of U.S. Treasuries would increase their market supply, potentially lowering prices and raising yields. This shift follows basic supply and demand principles, where increased supply amidst constant demand leads to price drops and higher yields. Elevated yields on U.S. Treasuries might result in greater borrowing costs for the U.S. government and higher interest rates across the economy. Given the Federal Reserve's current challenge with inflation, an uptick in Treasury yields could complicate efforts to stabilize prices without triggering a recession. Furthermore, an abrupt increase in Japan's sale of U.S. Treasuries could trigger market volatility. Such instability might prompt other investors to sell off their holdings, further unsettling global financial markets. This heightened market activity could lead to fluctuations in asset prices, impacting investors and financial institutions worldwide. Recent U.S. Treasury auctions have shown weaker demand, possibly indicating a shift in confidence among international investors. Japan's sale of U.S. Treasuries might also coincide with a repatriation of capital to Japan, especially if yields on Japanese government bonds become more attractive. This movement could strengthen the yen, affecting the trade balance between the two countries. A stronger yen would make Japanese exports pricier and less competitive globally, potentially impacting Japan's export-driven economy. Moreover, repatriation of capital could reduce demand for U.S. assets, influencing overall market stability. The broader trend of dollarization, where countries reduce their dependence on the U.S. dollar for trade and reserves, is another factor at play. Countries like China are diversifying their reserves by decreasing holdings in U.S. Treasuries and increasing investments in assets such as gold and other currencies. This diversification reduces exposure to dollar-denominated assets and mitigates risks associated with dollar volatility. Additionally, the adoption of alternative payment systems to SWIFT and central bank digital currencies, CBDCs, supports this strategy, providing new avenues for settling international trades in local currencies. For almost 3 decades, Japan endured a period of economic stagnation known as the Lost Decades. This era began in the early 1990s following the collapse of the asset price bubble. As a result, Japan's economy faced stagnant wages, stable prices for everyday goods, and near-zero interest rates on home mortgages. Several factors contributed to this prolonged economic stagnation. In the late 1980s, excessive lending and speculation fueled a significant economic bubble. When the Bank of Japan sharply raised interest rates in 1989 to curb inflation, it triggered a financial collapse, causing real estate and stock prices to plummet. This marked the onset of Japan's economic stagnation. During this period, both the Japanese government and the Bank of Japan made several policy missteps. These included slow responses to the crisis, reliance on interest rate cuts, and delayed handling of non-performing loans. Additionally, structural issues, such as complex relationships between economic bureaucracies and corporations, further complicated effective policy implementation. Japan faced deflation during this period, where the value of money increased over time, discouraging spending and investment. Despite implementing various monetary policies like quantitative easing and negative interest rates, deflation persisted, restricting economic growth and vitality. The country's demographic challenges, notably its aging population, also played a crucial role in this economic stagnation. With an older population, Japan experienced higher savings rates and reduced consumption, further dampening economic activity. External economic crises, such as the Asian financial crisis in 1997, also exacerbated Japan's economic challenges. Additionally, the strengthening of the yen made Japanese exports less competitive globally, contributing to prolonged economic stagnation. These factors collectively hindered economic dynamism and growth, maintaining Japan in a state of prolonged economic stability and stagnation. After World War II, Japan embarked on a remarkable economic recovery known as the economic miracle. This recovery unfolded in distinct phases, each contributing to Japan's emergence as a dominant global economic force. Recovery phase, 1946 to 1954. Following World War II, Japan confronted widespread devastation and a sharp decline in industrial output. However, with substantial American aid, especially during the Korean War, which fueled demand through military contracts, Japan swiftly rebuilt its industrial base. Priority was given to key sectors like steel, coal, and cotton, supported by governmental economic reforms that facilitated rapid recovery. High growth phase, 1954 to 1972. From the mid-1950s to the early 1970s, Japan experienced an unprecedented economic boom. This era was marked by robust domestic demand, the rise of a burgeoning middle class, and significant advancements in technology. Government policies, including strategic imports and the assimilation of foreign technologies, were pivotal. The Ministry of International Trade and Industry played a crucial role in coordinating industrial strategies, fostering innovation, and bolstering key sectors such as automotive and electronics. Steady growth phase, 1973 to 1992. Despite challenges, such as the oil crisis in the 1970s, Japan sustained strong economic growth. The country adeptly adjusted its export strategies and maintained high levels of productivity and efficiency, propelling continued economic expansion. Japan emerged as a leader in high-value industries, consolidating its position as a global economic powerhouse. Low growth phase, 1992 to present. The collapse of Japan's economic bubble in the early 1990s ushered in a prolonged period of economic stagnation known as the Lost Decades. Despite the enduring challenges, the foundational strengths established during the economic miracle enabled Japan to maintain its status as a major global economy. Focus shifted to addressing deflation, demographic shifts, and persistent structural economic issues that continue to shape Japan's economic landscape today. Recent developments and policy shifts, 2022 to 2024. Over the past few years, Japan has seen a resurgence in inflation, initially fueled by disruptions in global supply chains and escalating energy prices. By 2023, mounting inflationary pressures prompted the Bank of Japan, BOJ, to reassess its monetary approach. In March 2024, the BOJ opted to terminate its negative interest rate policy and raised short-term rates to 0 to 0.1%, marking its first rate hike in 17 years. This decision was influenced in part by a substantial wage increase negotiated by labor unions, intended to bolster consumer spending and stimulate economic growth. The cessation of negative rates in yield curve control, YCC, underscores a broader reassessment of monetary policy amid evolving economic conditions. While these adjustments are aimed at stabilizing inflation and fostering investment, they present challenges, such as heightened borrowing costs for businesses and potential impacts stemming from global economic developments, particularly in China, the largest trading partner of Japan. The decision to end negative rates in yield curve control reflects the Bank of Japan's growing confidence in Japan's recovery from deflation. Recent wage increases and a moderate economic revival have bolstered this outlook. These policy adjustments are aimed at stabilizing inflation and stimulating domestic investment, marking the new phase in Japan's economic strategy. What do you think the future holds for Japan's economy with these new monetary policies? Feel free to share your thoughts and perspectives on Japan's economic policies in the comments section below. Don't forget to join our community by hitting that subscribe button to stay informed about the latest economic strategies and their global impacts. Discover how these changes could shape the future of international finance.